Hi, and welcome to another episode of Investing for Beginners. Today we're going to start our conversation on investment strategies. This series is brought to you by ElderWatch Colorado. We are a 20 plus year collaboration between AARP and the Colorado Attorney General's Office. Our goal is to protect and educate older Coloradans in the realms of fraud and financial literacy. So if you or someone you know has experienced any kind of scam, whether it's related to investments or not, go ahead and give us a phone call. Additionally, if following these presentations, you want some more resources on investing, you can also give us a phone call. Our phone number is 800-222-4444, select option 2. My name is Jessica Zwadsky, and I am the program specialist for ElderWatch Colorado. Investment strategies are one of my very favorite concepts to talk about when it comes to investing. But before we really dig in, quick disclaimer, ElderWatch does not provide financial or legal guidance. So, what's an investment strategy? An investment strategy is related to an investment thesis, kind of. An investment strategy is a defined approach to investing that shapes your choices. So while an investment thesis is around a particular security, an investment strategy is more about your identity as an investor. It's kind of a more macro concept around how you choose to invest. One of the first things that you'll want to consider when developing your investment strategy is whether you want to be an active or a passive investor. Active investing involves frequently buying and selling securities or stocks. It involves really being aware of what's going on, keeping a pulse on investments, and thinking about the future, and paying attention most likely on a daily basis, if not multiple times a day, to the market. Passive investing is the opposite. Passive investing is kind of the idea that you're going to set it and forget it. Maybe you check in once a quarter, maybe you check in about once a year. And again, these highlight why an investment thesis is really important. If you're going to be a passive investor, you want to pick things that you think are going to be stable and where there's not going to be a sudden decline when you're least expecting it. Although, again, nothing in investing is guaranteed, all investments carry inherent risk. And essentially, the time horizon is how long you are planning to stay invested in the market. So, are you looking to make a bunch of money overnight and then take it all out to finance something like a house? Or are you planning to let your money grow over time so that you can benefit from compound interest? Now, time horizon in my head kind of goes along with active versus passive, but they don't have to. However, answering both of these questions, whether you want to be active or passive and what your time horizon looks like, are important first steps to developing your investment strategy as an individual. Risk tolerance is the last concept we're going to talk about in terms of informing your investment thesis. And really, risk tolerance is kind of about your willingness to gamble. So, would you rather kind of play it safe, invest in things that have shown demonstrated growth, ability to weather storms, even if it might just be right at that market average of 7%? Or would you rather gamble and take a bigger risk on something that might pay off, may not pay off, but if it does pay off, carries a much bigger reward? And that's what risk tolerance is. All right, so we talked about 3 concepts kind of in the abstract. So let's look at some of the specific questions we can ask ourselves to answer these questions. So if you're just starting out, 1, do you want to follow the market every day, or do you want to set it and forget it? That refers to the active versus passive question. Are you planning to take out your investment soon, or are you planning to let it grow over a longer period of time? That gets to our time horizon question. Are you willing to take a big risk for a possible big reward, or would you rather play it safe, even if that means that reward might not be quite as big? And then that's our risk tolerance. However you answer those questions, one thing you should keep in mind is diversification, and that's regardless of what your investment strategy is. Diversification, in a nutshell, can mean a lot of different things, but it kind of means not putting all of your eggs in one basket. So you could diversify by, for example, investing in at least one blue chip company where you know you're probably going to make around 7% a year, as well as some more aggressive choices with a higher risk tolerance where maybe you'll make much more. You can diversify by investing across different industries. So making sure that you're not just investing in healthcare, but you're also investing in information technology and energy. You can also diversify by investing in smaller companies or small cap companies versus bigger companies and blue chip companies, which tend to be kind of huge. But diversification is critical because unexpected events happen all the time. So this is one way to shield yourself from market volatility. If this is the first video in the series that you're watching, the other things that you've missed are investment fraud and scams and investment theses. Next time, we're going to talk about some of the more specific investment strategies, but it's important to understand your individual risk tolerance, time horizon, and whether you want to be an active versus passive investor, because each of those strategies is kind of a different combination of some of those factors. But for now, thanks for joining. My name is Jessica Zawadsky. I hope that this presentation helped your money make a little bit more sense, and I'll catch you next time. Bye.